Turn $100 into your first stock portfolio. Beginner's Guide. Ever wondered if you can start investing with just $100? The answer is yes. In this Beginner's Guide, I'll show you exactly how to turn a small amount of money into your very first stock portfolio. We'll cover the basics of choosing the right stocks or ETFs, avoiding beginner mistakes, and building a foundation that can grow over time. No complicated jargon, just simple, actionable steps to help you get started on your investing journey today. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Why starting small matters in investing? One of the most common myths about investing is that you need a large amount of money to get started. Many beginners assume they need thousands of dollars to open a brokerage account or to buy shares of major companies like Apple or Tesla. Starting small is not only possible, but also smart because it allows you to learn the basics of investing without putting too much capital at risk. Think of your first $100 as tuition money for your financial education. You'll learn how to open an account, choose investments, monitor performance, and develop confidence in the market, all while limiting your downside. Moreover, modern investment platforms now make it easy to buy fractional shares, meaning you can own part of a company's stock without needing to pay the full share price. For example, if one share of Amazon costs $3,000, you can still buy $50 worth of Amazon and own a fraction of that share. This opens the door for beginners with small budgets to invest in high-quality companies. Starting with $100 also helps you build the habit of investing regularly. Even though $100 alone won't make you rich, the mindset of consistent investing and reinvesting dividends can grow into significant wealth over time. It's about planting a seed now so it can grow steadily. Once you understand how markets move, how risk works, and how patience pays off, you'll be better prepared to scale up your investments when you have more money. 2. Choosing the right brokerage platform. Before you can turn your $100 into a stock portfolio, you need a place to invest. This means choosing the right brokerage platform. In the past, brokers charged high fees, making it almost impossible to invest small amounts of money. Today, online brokerages and investing apps have removed those barriers by offering zero-commission trades, no minimum deposit requirements, and the option to buy fractional shares. Platforms like Robinhood, Fidelity, Charles Schwab, Webull, and newer fintech apps like SoFi Invest or Public are beginner-friendly options. The right brokerage for you will depend on your needs. If you want a sleek app with simple features, Robinhood or Public may be a good fit. If you value educational resources and customer support, Fidelity or Schwab might be better. Always check whether the platform offers fractional shares, automatic reinvestment of dividends, called DRIP, and no account maintenance fees. Another important factor is security. Make sure the brokerage is regulated by the SEC and protected by SIPC insurance, which covers your account up to $500,000 in case the brokerage fails. Mobile apps now make investing so simple that you can fund your account with $100 in minutes and start trading the same day. Some even offer recurring investment features where you can automatically invest a set amount every week or month, helping you build discipline. 3. Understanding fractional shares and ETFs. When you only have $100 to invest, buying a full share of some big companies might be impossible. For example, a single share of Tesla may cost hundreds of dollars, and companies like Alphabet or Amazon often trade in the thousands. This is where fractional shares come in. Fractional shares allow you to buy a piece of a share based on the amount you can afford, rather than the whole share. If one share of Amazon costs $3,000, you can buy $50 worth and own 1/60th of that share. This innovation makes investing accessible to small investors and is one of the best ways to start building a portfolio with limited money. Another powerful tool for beginners with small amounts is exchange-traded funds, ETFs. ETFs are bundles of different stocks grouped into one investment, giving you instant diversification. For instance, an ETF like SPY tracks the S&P 500, meaning you indirectly own pieces of 500 of the largest US companies with just one purchase. Many ETFs trade for under $100, and fractional shares let you invest in even more expensive ones. This is one of the easiest ways to reduce risk, because if one company performs poorly, others in the ETF may perform well and balance it out. 4. Building a diversified portfolio with $100. With only $100, it may feel impossible to build a diversified portfolio, but modern investing tools make it achievable. Diversification means spreading your money across different companies or sectors so that you're not overly dependent on a single investment. Even with $100, you can balance between a broad ETF and a few fractional shares of individual companies. For example, you might invest $60 into an ETF like VOO or SPY for overall market exposure, $20 into a dividend-paying stock for passive income, and $20 into a growth stock like Tesla or Apple. This way, your portfolio has a mix of stability, income, and growth. Another option is to use micro-investing apps like Acorns or Stash, which automatically diversify your investment for you by allocating money into ETFs based on your risk tolerance. These platforms essentially do the work of picking and balancing investments on your behalf. You can also apply the core and satellite strategy. Make an ETF your core holding for stability, and add small amounts of individual stocks as satellites for higher growth potential. 5. Risks and mistakes beginners must avoid. While turning $100 into your first stock portfolio is exciting, beginners often fall into traps that can harm their progress. One common mistake is chasing hot stocks or trending companies based on hype without understanding the business. For instance, during the meme stock frenzy, many investors bought shares of GameStop or AMC expecting quick profits but ended up losing money when prices crashed. Another risk is overtrading, constantly buying and selling in hopes of quick gains. With small amounts like $100, every transaction fee or poor decision makes a big impact. Instead of frequent trading, beginners should focus on long-term investing. Emotional decision-making is also dangerous. When markets dip, many panic and sell at a loss. But downturns are part of investing, and holding through them often leads to recovery. Another mistake is ignoring fees or hidden costs. Some platforms may have charges for withdrawals, inactivity, or certain transactions, which can eat into small investments. Beginners should also avoid putting their entire $100 into penny stocks or highly speculative companies, thinking they'll get rich quick. While it's possible to make money this way, it's closer to gambling than investing. 6. The power of compound growth. Many beginners underestimate the power of time and compounding when it comes to investing. With only $100, you may feel your portfolio is too small to matter, but compounding transforms small amounts into large sums over the years. Compound growth means that not only does your original investment earn returns, but your returns also start earning returns. For example, if you invest $100 in an ETF that grows at 8% per year, in 1 year you'll have $108. If you leave that money invested, the next year you'll earn 8% on $108, not just the original $100. Over decades, this snowball effect turns modest contributions into significant wealth. If you continue adding just $100 per month to your portfolio, and it compounds at 8% annually, in 30 years you'll have over $140,000, even though you only invested $36,000 of your own money. This demonstrates why starting early is more important than starting with a large amount. Another key aspect of compounding is reinvesting dividends. Many stocks and ETFs pay dividends, which are small cash payments to shareholders. By reinvesting these dividends back into more shares, you increase your ownership and boost future returns. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.